Well, good morning, everybody, and we are now mic'd up. Thank you for attending today. If you think you're in the panel entitled Investors Speak, you're in the right spot. If that's not the panel you were planning to attend, still time to quietly slink out the back door, grab a coffee, and go to a better panel, but it probably won't be as good as this one, in fairness. I'm Rob Lytle from EY-Parthenon, a consulting firm, obviously the best consulting firm in the education space, despite the fact that there are a whole bunch of my competitors wandering around here today who also do a great job. But it's my privilege to interview and moderate a panel here with three folks who do investing in this space. So with me, I've got, and actually, well, we even went left to right, so well done. At the far end, Jennifer Carolan, co-founder and general partner at Reach Capital. John Duong, the impact investor from Lumina, who can provide, I think, a great insight into, and I think I can say it at this panel, early days of impact investing as opposed to the horde of impact investors who are coming in at this point in time. It's the hip thing to do. And then Adnan, who is a partner at Vistria, even though in my moderator notes I dropped the V and called him the Istria Fund. They're not quite on Fund 5 yet, but really more in the classic PE mid-market expansion capital in areas like that. We've got about 42 minutes this morning to explore questions around investing. I'm going to do my best to pose a few questions to these folks, but really let them riff, save a little bit of time at the tail end for the audience to ask questions, and we'll take it like that. I wanted to start with the where. You know, it's a little weird. We say investing in education, and you know, different folks define education differently. I run an education practice, so anything with an instruction manual pretty much looks like an education business to me. But you know, you got a range everywhere from pre-K to you know, adult workforce learning, consumer, institutional, et cetera, early stage venture to growth capital and publicly listed institutions. I'm curious, and Jennifer, I'd love for you to kind of give a bit of a perspective of, you know, where are you hunting today? What parts of the sector do you see as interesting to deploy capital into?
Sure. Hi, everyone. Delighted to be here, and thanks for having me on the panel. So our fund is, we're investing out of our third fund, and we started out as a K-12 focused fund, mostly K-12 SaaS, and we've since expanded into B2C, early childhood, higher ed, lifelong learning. So we have about 83 companies across our portfolio. And I would say we still love K-12.
Mm-hmm.
There's a lot of sort of naysayers about K-12 recently, but we still are finding great companies in the space and still love the space.
And strong valuations recently in the right spot.
Yeah, definitely. And higher ed as well. We invest in SaaS and also direct consumer and higher ed. We're finding more interesting companies in early childhood, which has traditionally been a really challenging place for us to invest. I would say I think I'm really interested recently in the intersection of kind of school experiences and outside of school, more like a kind of Airbnb experiences model, like how can we combine the two and have these hybrid experiences. Then we're seeing a lot in voice analytics too, a lot of new companies in that space.
John, I'm going to talk about coffee.
Don't die on us. We need a moderator. So, you know, I think for us, because we are impact investors, there are parameters in terms of where we focus our effort. Not surprisingly, trying to close the attainment gap is an area that we think about very front and center, as well as understanding the skills gap in terms of what the employers are looking for versus what the institutions and or these alternative learning programs are trying to train for. So one of the things that has particularly been a focus for Lumina, given our mission, is around the returning adults. That's a very large population. I think it ranges, depending on who you ask, about 36 million on the low end to 42 million. That's a huge amount of individuals who have not completed some form of a higher ed program. And so we look for opportunities to invest to address that population because it is a huge driver of our society and hopefully for success and social mobility. And we think about it across a couple things. In the past, it used to be around access to these higher ed programs, but now it's actually more focused on making sure that they complete. So retention programs, student support services, and particularly what are the ways to accelerate the returning and completion of these individuals who have dropped out, particularly understanding the unique dynamics that these students, or learners, I shouldn't say students, learners, are trying to address, which a typical 18 to 24-year-old would not typically have to struggle with. Things like childcare, things like work schedule. And so as an example, I'll give you one example of something that we've invested in is, actually I can't announce this yet, this will come out tomorrow. The other one is around student scheduling. If you think about the issue, I actually have some Ricola. So this company that we've invested in is it's a scheduling optimization company called EduNav. And while it sounds really simple, if you think about a lot of the existing programs, it's really structured for one semester of decision making and which classes you're selecting. However, what often happens, in fact, we had a summer intern last summer who literally had this happen to her. She had planned on taking a class when she came back for the specific semester, and it turns out that class was only offered every other year. So she lost a semester of having to spend at school, and that's a lot of cost. For most students, potentially it's not a big deal when you're middle income, but when you're a low income, that is basically a cause for dropping out because your financial aid will not cover that extra semester. And that's a terrible loss. For this company, essentially what it does is thinking about scheduling across the whole degree. So all 4 years, all 5 years, however long you want to take. If you can't take a class during an afternoon and Thursday because you have to work, it will take that into account real time and then calculate the cost. It will be incrementally for you to not take that class at that time, as well as the time it will take for you to actually get that degree completed. We want to connect that into some of the other pieces of our programmatic and investments in which if you can tie that to a marketplace, if the classes can be offered somewhere else, you can plug that in there, right? So we think about that from a very holistic manner. Good?
I'm going to try here. We'll see how successful I am. This is, by the way, straight out of How to Not Moderate a Panel, right? Have a coughing attack in the middle of it. I'd like to get your perspective, maybe tie it into a little more on some of the macro trends that you're seeing in this sector.
Sure.
And what's giving rise to interesting investment opportunities out there.
Absolutely. So as a middle market investor, we are impact focused. We strongly believe that private capital can and should have social impact. So a little bit of what my colleagues have said it would be consistent with where we're seeing opportunities. I would say in terms of trends, I'm going to try to give more of a, to be mindful of this audience, the investor's perspective. So I'm not going to talk about what's going to happen with HEA or anything like that. But one big trend is consumerism. I think in what has historically been viewed as more of a B2B or B2G sector, there's, with the advent of the smartphone, with this idea of access, we're seeing a lot of businesses trying to figure out how to directly interact with the consumer, whether that's a parent, a teacher, or a student. And I think that as a result, you're seeing a lot of technology and innovation in the space. So another kind of macro theme or trend that's interesting is that you have all this technology innovation, but the businesses that are, I think, thriving and scaling are the ones that are also understanding that they have to have some kind of a services component. So if you're selling into K through 12, how do you think about the professional development that's wrapped around that to create, frankly, just usage and stickiness? Similarly, I think somebody had mentioned OPMs in the prior panel, but the successful OPMs are the ones that use technology, but also recognize at the end of the day that they're serving students and faculty and administrators, and that there has to be that services component. I think with all that technology, there's been a lot of capital that's come into the space, particularly in the early stages, a lot of human capital. I'm always impressed with all the talent that's in the space. People are very mission-oriented, and education, that mission is very tangible. And so you would think that there's this opportunity for significant consolidation. Particularly as a middle market investor, we've always hoped we could find great platforms and then be a part of the consolidation. The challenge, however, has been valuations. And so there hasn't been as much consolidation as there
That's
probably...
only a challenge on entry, right?
Yeah, that's right. That's right. Yes, we've benefited from valuations on the exit for sure. And then I'd say the last thing, which I think touches a little bit on what John was saying around the adult learner, but really the role of the employer. Having been just thinking about the last 5 years, Frank was up here when we were invested in Penn Foster. We were frankly frustrated that employers weren't really seeing that, hey, the millennial employee wants to feel like their employer is investing in them, right, as opposed to going from job to job. And it was more of a corporate social responsibility in the HR department. But I would say today, and maybe I'm being a little optimistic or naive, frankly, but I do get the sense that employers and CEOs in particular are starting to think about education as one of the key 5 or 7 things they think about in terms of their ability to continue to grow their businesses. And so that's really an interesting trend that is picking up momentum.
Let me push on 2 things that came up here, because I think it is reasonably fair to say that historically education was very much a B to G, or at least that's how it's thought about. We've had corporate training, childcare, et cetera, but particularly in the audience and the companies that are walking the halls here today, there are 2 areas that seem to be a big focus. One is B2C, right? So an enormous amount of startups and growth capital in B2C education environments. And the other is in corporate, which I think, in fairness, if I dig under corporate, it's workforce training, right? Or workforce development types of initiatives. I'd love to get your perspectives on those, and particularly whether you think that a lot of the deployment of capital in there is going to see a good return, or are we chasing great ideas that don't have commercial opportunities?
What do you mean by that last comment?
By that I mean the prototypical thing is we're revolutionizing the way textbooks are built. People don't understand what they want. The consumer doesn't know what they want. My response to that is actually the government issued an RFP and was reasonably precise about what they were looking for and how it's going to match against that. My observation would be a lot of the early venture things I see in education in the B2C world don't necessarily have an audience, unless I'm tragically wrong.
I'll let them start, because I don't want to be the cynic to start.
Well, you're one of the few people who, in higher ed, invested behind a business that said, no, we won't take government money in Penn Foster, right? That was a pretty radical position to take. So
They've only been around 125 years, but yes,
fair enough.
we were pioneers.
I guess I can start on this. I would say that the B2C model is tough, but I think if you do it right, there are opportunities. We actually looked at one recently. It was kind of a mix B2C, B2B, and we turned it down because I think it was probably targeted to cost savings to the student, from the example you gave around textbooks. And the concern is that yes, the students would want it if it saves them money, as long as they can actually leverage it as well as they would a normal textbook, which is fine. We got over that hump. The issue that I think we struggled with was the ramp up, the sales, the scaling was so slow, and a lot of it was because not understanding who to sell to and how to sell it, and that's the big issue. How do you, even if you have product market fit, if you don't have the right, call it traction in terms of who to go to get that traction, that's a challenge. And I think as an investor, we have to think about the viability of the business model and the potential to reach the scale that it's supposed to reach. Even if the product is really good, if the team is not able to demonstrate their ability to navigate that, it's just not a risk that we're willing to take because we can't be convinced of it.
Yeah, I guess I see huge opportunity in that space. Half of our portfolio would be categorized that way. And they tend to be the faster growing companies as well.
Well, they're not slowed down by an institutional sales cycle that is 18 months in length.
Exactly, yeah. And I think that actually I was just doing diligence, some research on a company the last week or so, and I was looking at, it's a consumer company in higher ed, and I was looking at the existing products out there that were the main competitors. And it's shocking to me that like these products are used by millions of people and they're still using Flash technology. Flash has been deprecated, it's being shut down, Chrome will no longer support it 2020. And like this is one of the lead companies in the space.
Yeah.
It's an
Can
engagement.
I push on that a little bit? Because I think
surprising.
it is a fair statement in a lot of education products, digital products, that the technology is a little outdated. And as an investor, how much time do you spend
that one's
on
from the 80s or 90s.
on what we would call the technology deficit, which is, you've acquired a company, you wake up the next morning and find out that it's not scalable, the code is old, and you need to write a $15 million check to update.
Yeah.
How real is that? Like, how much time do you spend on that when you're looking?
Huge. That's one of the number one things we're looking at. Like, I think the user experience matters a lot. And when you have products where you have to, because it's not supported by Chrome, for example, you have to reload every single time you're using the product. I mean, I don't understand. I think this is why I got into investing, is that why is it that we have cutting edge technology in shopping and banking and all of these other spaces, and then we have crap for our teachers and students? And it's just not fair. Like, it's not good enough to support products out there. Investors should not be supporting products that are using that kind of legacy technology. And it's so expensive then to find these engineers who wants to work on Flash or Drupal or any of these old platforms.
The only, I think in the middle market, what's been interesting is the businesses that have scaled were frankly technology pioneers, right? So University of Phoenix, for example, when we invested in the business, had I think something like 750 software applications, most of which were proprietary. I remember somebody told me we had IP around marketing software, and I said, I don't think that's that valuable today. There's this thing called Google. But if you think about 15, 20 years ago when these modalities were newer, these providers had to build the technology, and so there's significant tech debt. But it's hard because culturally you have to make that shift. So it's a little bit easier when you have more of a digitally native business that still, it sounds like, can have some of the same challenges. But I mean, that is a real issue, is because the consumer is expecting the Amazon, the Uber experience, but the provider, the curriculum, however you want to think about it, can't offer that experience. And culturally, from a process standpoint, it's very hard to meet the needs of the customer. And I think, frankly, maybe to your point, Jennifer, the customers just kind of accepted it, which is unfortunate.
Yeah, but as the market, as more money pours into the market and more startups are created with better user experiences, they're not going to accept that. They're going to go around.
Yeah.
John, maybe turn to you for a little bit. You've been an impact investor for a long time. And I joke sometimes, but it seems today there's a new impact fund almost monthly, right? And by impact fund, at a very sarcastic level, it sometimes means I invest in education, healthcare, and social impact, right? And therefore, I'm an impact fund. Talk to me a little about what does it mean to be a true impact investor? And what is it that differentiates a impact investment fund or individual from other sources of capital in terms of attracting capital to invest and in appealing to management teams and CEOs to be their partner?
Yeah, it's a very broad, loaded question. We can spend an hour on that.
We have 7.5 minutes budgeted.
I'll keep it really short, proportional to my height. So the way that I define an impact investor, and it spans a spectrum, is someone or an organization or institution that ultimately uses a financial instrument to drive change, positive change, hopefully. And essentially, you can be along that full spectrum of someone who says, hey, I'm not causing any harm, therefore I'm an impact investor. And this is your typical ESG, particularly in the public market. On the other end of the spectrum are your very devout, passionate, bleeding heart. It's got to drive impact, because if it doesn't, then you are not an impact investor. I've been on both ends of the spectrum. I started as an evil banker, so I've kind of adapted over time. But I also understand that, if you really want to drive impact, there are ways that you need to structure the investment in a way that is beneficial but not completely compromising, where you're giving up a lot of potential upside and taking on ridiculous risks. The math doesn't work for the long-term sustainability and scalability of whatever that solution is. So from an investor standpoint, at least this is John's definition, I won't say Lumina or Kellogg when I was there, is that I do believe it is, for your own sort of definition, if you believe that your investment is going to drive positive change, then that's fine. You know, even if that means for you, as long as you're not causing harm, you're comfortable with it. For me personally, I actually believe that every investment that we make has to drive something positive. But it has to be an investment that actually drives a financial return, because you know, people often say without profit, you're not going to have purpose, you're going to be defunct. And vice versa, without purpose, you will be profitless long term. So how we think about our investment is, for every specific opportunity, we vet the alignment of the mission of the entrepreneur. You know, they could be a B Corp, or they could be a typical, you know, structured corporation. And we don't actually use that sort of filter, because a lot of people say, hey, we're slapped on the B Corp. It's just like a fund that says, hey, we're an impact fund. It doesn't resonate until you drop below that surface level and start digging into the way that they're doing business, who they're trying to serve, the alignment of how they think. And you can vet that through your reference checks, through meeting with management, through understanding who and what the ultimate business model is trying to serve. And ISAs is a perfect example. Sounds great. It's going to do a lot of good. But when you look at the structure of how some of these ISAs are structured, it's actually, in some cases, worse than a typical, you know, payday loan.
Yeah.
And so, from my perspective,
Maybe not payday loan levels, but
you'd be surprised in some of these folks that we've seen and pitched. But at the end of the day, we track a couple social metrics for each of our investments that are standardized, and we roll it up to one key component: how many students did we serve, and how much capital did we leverage, things of that nature. But there will also be customized metrics specific to the technology or service that's being offered by the company. For us, that's how you keep yourself honest and you keep the entrepreneur honest. And if you're not doing that, then you're essentially almost on the spectrum of, hey, we're not causing harm, right? Again, it's debatable, but at least that's my philosophy on it.
Do you mind if I just add one thing? This is very aspirational, but it's making the difficult choices between profit and what is ultimately the right business to be in long term and what's sustainable. So, you know, we have an investment in an OPM, and it's mostly graduate programs, no surprise, but undergraduate is this huge opportunity. The challenge is it's a very different student, right? It's much harder to serve an undergraduate student and get them to have the same type of graduation rate. So the question is, do you go into that space even though your customers in the market would say you should be, you know, you should be offering online undergraduate programs? And so that's the tough choice is,
right.
Do you do that because in the 3 to 5 years that we're going to own the business, we can really grow the company from an EBITDA standpoint, but did we do the right thing? And I'm not saying we always do the right thing, but that to me is really what differentiates someone who's not trying to do harm or can justify raising the capital from the LPs that now want some kind of ESG box checked versus making the hard choices. And I think that's aspirationally what we should all hope that we can do.
Should impact funds be held accountable to KPIs? Should they have to report?
We, many years ago, we invested in one fund, which I won't mention, which it's actually quite innovative in terms of how we structured the carry. The GP was ultimately willing to accept the annual performance, not just on the portfolio in terms of how they were doing financially, but the social metrics that were tracked for each of these investments. And if they hit a certain level, the percentage of the carry they actually earned.
They tied carry to it?
Yeah.
Wow.
And that because it was a first-time fund and the guy didn't have a lot of experience. But but you know it.
He didn't do that on Fund 2.
But that fund, yeah, Fund 2, that did not happen. But they did a really good job. The first fund did really well. There's a couple pretty interesting investments.
I think you got to be careful sometimes with the KPIs. I've seen in the early days of like school reform impact investing, some of the metrics were around all like free and reduced lunch students, the K-12 and the like Pell Grant numbers. And what happened is you had these companies that were funded that served predominantly low-income students, and they didn't pay attention to sort of the scalability and the ability of that company to raise capital. So then you had these sort of parallel tracks of products. You had the kind of low-income product, which was crappy and couldn't raise additional capital and couldn't attract the best engineers and talent. And then you had the product for the mainstream and affluent kids, which ended up being a lot better. So, you know, I think that that's like an unintended consequence of when we sort of are well-intentioned, but it distorts outcomes.
Yeah, if it's okay, let me clarify. I totally agree with that. I think at the end of the day, if you do have KPIs, they have to be realistic and not so structured to a point where you are causing that type of behavior.
Yeah.
And you're incentivizing the wrong thing. That said, you know, if you diligence the management team or the GP well enough, in theory, as long as they are very well aligned in intention, and you can gauge that pretty quickly. People will bullshit you, but you can smell that pretty early. The reality is, if you need to put KPIs in place to make sure that they do that, that's not a good way to start. You know, so philosophically, while I think they're useful, I think a lot of it is upfront diligence, understanding who you're investing in, who's actually executing, driving the strategy, and if they are people you are confident are authentic about that mission, then in theory, the KPI as a requirement for the fund may not be as necessary.
Mm-hmm. And we also find that when our companies reach 3 to 5% market penetration into K-12 or higher ed, their demographics reflect the national averages.
Interesting.
Usually.
Yeah. The other thing is you may also lose potential new investors by restricting the leadership team with the KPIs. Mm-hmm. So that's something to think about too in balancing that.
So we brought up unintended consequences. And unintended consequences quickly leads us to regulatory environments. We're in the middle of a pretty vicious and interesting political debate. I'm not going to ask you to tip your hands as to which side you're going to stand on in the election. But last week, Senator Warren fired off, you know, her letter to the OPMs, which can only be described as round 2 of for-profit. And there's a big debate within the country about the appropriate role of for-profit and very specifically private equity-backed education companies. I'd like to get your perspectives on how does that impact the way you think about investing and where you might put money? How much of a concern is it? And Adnan, I'd love to start with you because, you know, your firm in particular is reasonably well politically connected from the previous administration, but, you know, specifically designed to invest in regulated areas.
All right.
Just put you on the hot seat right there.
Look, this is where I think what's really fascinating is if you think about the longer-term policy objectives for our country, I would think everybody in this room wants to do the right thing. The question is, what's the right way to achieve those goals?
Yep.
And this is where I'm probably on one camp firmly, is that the private sector has to play a meaningful role. And then I think that means a couple of things. One is having the mindset that you're going to make trade-offs in the short run that may not necessarily result in the profitability that you'd expect in the short run or the growth profile you expect in the short run, but that long-term you're building sustainable enterprises that are good actors for all stakeholders, and that requires conviction, but there's a role for the private sector. And then it's the advocacy piece. And what has surprised me as someone who's relatively new to this space is the lack of dialogue or the inability for the conversation between the legislators and the policymakers and the management of some of these businesses or the investors. So that's something that you have to be mindful of in this space, is that you have to be willing to be an advocate. And back to the KPIs just a little bit, you have to be able to look yourself in the mirror and say, yeah, my graduation rate is this, but I'm going to get better, right? And be honest about that and have that conversation. So I think there's a definite role for the private sector. I just don't think that the public sector in and of itself is going to create the innovation that we need, but we have to be able to have a dialogue. And so some administrations, some folks are a little bit more open to a dialogue, which I think helps, but we can't not have private capital in this space because we're not going to achieve the long-term objectives. And if you come with that kind of conviction, I think ultimately we're going to have good outcomes.
Yeah, I'll jump in there. I think what we often have to be careful of is perception. And I saw that article, a colleague of mine forwarded it to me as well, and we've looked at the OPM space. This market is going to keep growing. The OPM market is not going to disappear. And so how you finance it, may change. The business model may change. But we also have to be open-minded that innovation, there may be the field may have a lot of bad actors, but there may be innovation in the field with good actors. And our role as an impact investor is to think about those opportunities to support innovative new companies or solutions that are the good actors within a space of a lot of bad actors. And that's something that we think about quite often, and we'll look for those. We're not going to shun away just because there's a lot of bad press, although it is a lot harder to get it through the investment committee. We're going to struggle with that. But it is our role to take that opportunity to support those potential innovations that can change the ecosystem. And if you don't do that as a philanthropy, an impact investor, then there is no one else who's going to do that. And these innovative opportunities that can change that system for the better won't survive. And so that's a role that we think is important for us as an impact investor to play.
Yeah, I agree with the comments made already. And the private sector has always had a role for public education back to the McGuffey Reader in the 1800s. And it's full of, our public schools are full of private sector companies. So I think that, actually I think venture capital can have an important role in improving the quality of those companies and products.
I'm going to ask one more question, but open it up to the audience here. So if you've got a question, I think we have a mic to pass around. Otherwise, just be very, very loud. Jonathan Katzman put out a piece in Inside Higher Ed maybe 2-3 weeks ago, his predictions of the future. One that caught my mind and is relevant here is that the for-profit sector will start to self-regulate better. Is there a role for that? More self-regulation?
You asking me?
Either one of you, I'll let you. We didn't choose this one in advance.
Yeah, no. I don't think that there's a choice. I think anybody that is investing private capital in this space and ultimately has shareholders that have expectations of a return, we have to be mindful of the fact that we're operating in a broader ecosystem and that we have to be making a difference and having an impact, but also have the confidence. I mean, it's basically what I said before, the confidence that what we're doing, we're marginally improving over time. But I think if we all sit around and wait for the ebbs and flows of the changing administrations or somebody realizing there's a business model out there like the ISAs, someone's going to realize that they're payday type loans, right? And that you're shifting the burden from one borrower to the other, that's a problem. It behooves those of us that are investing in these businesses to be mindful of the fact that if we're not serving students well, we are ultimately going to lose money because there's going to be broad brush, right? If you think about regulators, it's very few
You're all bad
levers.
actors if there's
Yeah.
one bad actor. It's an interesting question because unique, I think, oddly right now in the education landscape, most of the proprietary players are actually in the hands of some form of capital. So the boards actually are almost entirely private capital boards in some respect. So that weird ability to self-regulate exists here, I think, as in other industries, there's no common coalition. So it's when he said that the other day, I was like, that's an interesting perspective, and one which has failed to materialize in the past, and perhaps for other reasons, but interesting. Questions from the audience? Michael?
Jennifer, I really appreciated the article you wrote in EdSearch about the importance of measuring efficacy and
Thank you.
impact I'm wondering from all of you, Frank Britt used the word physics.
Stand and be loud.
Frank Britt used the word physics a couple of times, and I wonder if you're observing the beginnings or betting on beginnings of a change of physics in the market to a place where learning impact is actually going to drive investment value and is actually impacting the way products are adopted and used.
So, will the actual impact of a product or solution in the marketplace drive investment decisions going forward? And
It does for
I think
me.
it does, right?
Yeah, it definitely does for me. And I think what has happened traditionally is that the way that we've assessed the efficacy of products is through the randomized control trial, which is sort of an outdated model in some ways for the pace of innovation right now. So in the article, I was trying to make the case that we need a way to have sort of efficacy engines almost within the businesses that we're investing in the companies. So they can constantly be assessing is their product doing what they set out to do? And that's a really important part of the diligence process for me.
But John, to your point, great impact with no route to market.
Yeah, it's going to die in the graveyard somewhere. We actually have an investment in a company called Civitas Learning that recently released a tool called Impact. It literally is a way to assess the efficacy of whatever the solution, technology, intervention is. And it's not specific to their product. So any institution that wants to test, let's say, hey, we have this campaign that we just did. You can literally, within an hour and a half, based on the data that they have of all the students, slice and dice that data, understand what the return on an investment was. How much did you spend? What improvement did you see? And you can compare it to some type of control. But for most institutions to do that in the past, it would take you a year to 18 months to do an RCT.
And hire a consultant. I mean, this
Exactly.
product sounds terrible. I don't like it at all. I'm naming my business.
The only thing I would add is if you really focus on student outcomes, I think there is this element of consumerism. What is the ROI, which is ultimately quote unquote impact, and so you will be out of business if you're not, if people aren't going to buy from you. And so I think it is ultimately going to be as it goes away from B to G to more B2B.
One of my first clients in the proprietary education space, vocational, his comment was, the best way to have a profitable school is to have a good school.
Right.
Exactly.
It's like, if it's not a good school, it's not going to work out in the long
Much
run.
better articulated than what I said.
Time for one more question from the audience.
Thank you.
Oh.
My company started as a K-12 digital skill development program, and that has evolved into also developing programs for delivery to adults via higher ed, generally continuing education or workforce training. Oh, sorry, I was trying to speak really loud. That's better. So we started as a K-12 development digital skill development program, and that has evolved into also building programs for digital skill development for adults to be delivered primarily through higher education. And I'm just wondering, as investors, do you believe that companies can be effective in both worlds, in both K-12 and higher ed? Or do you believe that it is, from an investment perspective, more preferable to work with organizations that are focusing on one area of the market versus another?
And was it a pivot or a product extension?
Yeah.
I do think that they can be successful in both. We have a company, Nearpod, for example, that started in K-12 and is now in higher ed as well. So, but I think that you have to sort of nail one first and do really well with that and understand all parts of the business deeply, and then before you move into the adjacent market, and then have to know all of those players and how that works. It's hard, but it can be done.
Yeah, I agree with that. I mean, I think there's a company that does social emotional learning as an example, whether it's K-12 or higher ed or workforce, that the components are similar in terms of how you think about assessing and leveraging that. I think a lot of it will depend on the entrepreneur. As Jennifer said, are they really good at what they do in the space that they've entered? Are they able to navigate and change the way that they think about selling? Because selling to K-12 versus selling to higher ed is very different. And that is highly dependent on the leadership team.
Great. I'd like to ask you to join me in thanking our panel today. There'll be a 15-minute coffee break usually, so crowd the stage and ask the questions you didn't get to ask in the general population pool, and thanks for coming.